In this lecture, we are going to look at something called the Howie Test, which is central to the legal and regulatory structure of cryptocurrencies. Cryptocurrencies occupy a bizarre and gray portion of the legal landscape. This is partly due to their novelty. Quite simply, blockchain technology and its accompanying cryptocurrencies haven't been a part of the landscape long enough for banks and regulatory agencies to make much sense of them. This is also partly due to their anti-authoritarian nature. In Satoshi Nakamoto's white paper introducing Bitcoin, one of the fundamental reasons a cryptocurrency has for existing is skirting third-party regulation. Indeed, cryptocurrencies via a distributed ledger provides its own internal regulation and enforcement. That's the ideal situation anyway. In the real financial world, the situation is considerably more complex. The U.S. Internal Revenue Service has already clarified that trading cryptocurrencies are a taxable event. Moreover, the U.S. Securities and Exchange Commission or SEC has deemed that cryptocurrencies pass the Howie Test, are therefore securities, and subject to securities regulation. Let's take a look at the Howie Test, how it applies to cryptocurrencies, and how it impacts the market moving forward. The genesis of the Howie Test was a 1946 Supreme Court case. In the case, the titular W.J. Howey Company sold citrus grove plots to outside investors. Howey and the investors reached an arrangement whereby the buyers would immediately lease the groves back to Howey, which would harvest and sell the resulting citrus products. The Supreme Court ruled the citrus groves, in this case, constituted an investment contract and thus, a security. It applied four main criteria in making this decision, which subsequently became known as the Howie Test. In order for a financial instrument to be dubbed a security and fall under the purview of the SEC, the instrument must meet these four criteria. It must be an investment of money, with an expectation of profit, in a common enterprise, with the profit to be generated by a third party. The citrus grove in the precedent was bought with money and an expectation of profit by a pool of common investors, and its success depended on Howey's ability to profitably make money from selling its citrus products. Stocks are a more familiar type of security and they also pass the Howie Test. A share in U.S. Steel is bought with money in the hopes that the share will eventually be worth at least as much as its initial purchase price. This is done in a pool with other investors, and they are at the mercy of U.S. Steel's board of directors when it comes to profits. That last bit is key. The hammer of securities regulation comes down when the investor can't do much of anything to impact whether an investment turns a profit. Ostensibly, the registration and financial reporting requirements that go along with regulation are to protect investors from predatory scams. Again, that's how it works in an ideal world, with large companies employing the kind of high-priced attorneys and accountants needed to comply with the regulation. Cryptocurrency initial coin offerings turn that established system on its head. The developers of coins are not huge multinational corporations but small startups, sometimes just a single person. They do not have the financial, political, or legal clout to do their own research on whether their initial coin offering complies with applicable security regulations. In fact, up until 2017, it wasn't clear whether cryptocurrencies were securities at all. In the next lecture, we will look at the potential alternatives to the humble ICO.